Hello traders, welcome to Zion Traders. So today we'll be talking about fundamental analysis in Forex, right? So we are going to understand the reason behind the candlesticks, and also we are going to get to understand how or what moves currencies beyond the chart. Most of us, we are familiar with the chart, we are familiar with technical analysis, but then we don't know why the market moves, right? So but then we already know how it moves, or we at least have understanding of how the market moves, right? But then we don't know why it moves the way it moves, right? So what is fundamental analysis? Fundamental analysis in Forex is the study of economic, social and political data that affect a country's economic health, financial news, government policy, right, to predict the value of a nation's currency. Think of it this way: you are actually not trading money, right? You are not actually trading money, you are actually trading countries. That is pretty much what you do in the forex market. So let's examine the concept of supply and demand now. But before we examine the concept of supply and demand, let's just go back a bit into the history of forex trading. In the early beginning, it all started with a barter system. There was nothing like forex actually then, but then it all started in 600 BCE at Lydia, a modern day Turkey, right, when they minted the first coins, right? So as international trade started, money changers, right, so they started gaining profit from the difference between a country's one country's uh currency value and the other country's currency value. So that's actually how it all started, right? So it now got to this standard, the gold standard. This gold standard, it does during 1870s to 1914, when countries' currencies, they were actually pegged to the gold, right? So that's actually what was done then. During this period, forex was actually hard, saying that it was more of stable, right? So this actually moved on to the Bretton Woods period or system. So the Bretton Woods system, it's actually when the currency of countries were pegged to USD, right? So but this only lasted just for a few years, from 1944 to 1971. And in 1971, President Nixon abandoned this system, right? So and after this system, this led to what they called supply and demand, right? So that's actually the post 1974, right? So that's actually what brought about supply and demand, in the sense that what moves the prices of currencies now is now based on the supply and the demand of that particular currency, right? So currencies are affected by supply and demand just like any other commodity, right? So the more the demand for a currency, it strengthens; the lesser the demand, it weakens. Just think as like it this way: you have a shop, right? So the more the demand for your product, the more you tend to grow. Your business tend to grow, everything tends to boom, right? So that's pretty much how it works. And then if the demand for your product is less, you won't grow. Actually, you'll be stagnant, or you won't have to eventually even fold up, right? So let's talk about this a strong economy, right? It actually leads to increased demand for that particular country's currency. And then the more the demand for that country's currency, the more the value of that country's currency rises, right? So for instance, let's say the interest rate let's say in Nigeria right here, the interest rate of Nigeria is increased. So and then the economy itself is stable. What that will do is that it will attract investors, right? And then in many investors, they want to buy naira, right, now for them to use to invest in the country, right? So they want to buy naira to invest. Why? Because they'll be getting more interest based on their investment, right? For example, if US economy is doing great and the interest rate is very high, right, many people will want to buy what? USD, and this will make the demand for USD to be high. And when the demand is high, it makes USD to be strong, right? So why fundamental analysis matters? Let's just talk about few reasons why fundamental analysis matters here. First, it gives you direction. You get to know which currency will be strong or weak with fundamental analysis, right? So that is pretty much the first reason right here. And secondly, you get to understand the news. You don't have to panic during news data. Why? Because you have insight on what is most likely going to happen even when the data is released, because you have already gone through their statement, or you've looked into the country's head already, right? So also trading edge, right? It helps you not just to depend on the chart alone, how the market moves, but then why it moves, right? So it gives you a clear directional bias, right? And then you just go to the chart and you look for where to enter and exit, right? So it helps you to trade smart. You understand how institutions think, right? So institutions, the decisions of institutions moves the market more than the institutions of retail traders. So if you get to understand how institutions, how they think, it will help you to trade in line with their biases, right? So that's pretty much it. It will give you more precise, right? So it helps you to interpret news correctly, right? So you get to know which data, economic data or news that is released really matters and why, right? So that's pretty much it, guys. So what moves a currency? Let's examine this. This is very important that you know what really moves a currency, right? So because not all economic events that are being released actually moves the currency the same way, right? So the first, we have interest rate, right? So that's the first factor that moves the currency. And then what it means, it actually means the cost of borrowing. And then what's the effect? A higher interest rate, it means a stronger economy, but then a lower interest rate means a weaker, sorry, currency, not the economy itself, right? So let's talk about the second factor here, which is inflation. Generally we tend to see CPI is pretty much the inflation, right? So CPI, it has to do with prices, so of goods. So if the prices goes up, right, so inflation is rising, right? So it's going up, it's hiking. And what you tend to see is that central banks, they will hike interest rate. And when central bank hike interest rate, it will make investors to be attracted to that particular country's currency, and then they will have to invest in it. More investors will invest in it, and it will help the currency to be stronger. So let's talk about GDP right here. It actually measures the economic growth. And then if a country is growing, right, so GDP is actually the what the country, that particular country, their production. So if you see the volume of their production is growing, so it actually helps the currency to be stronger, right? So let's talk about employment, job markets head, right? So more jobs will lead to more or stronger currency. That's actually the effect, right? So when a country economic is growing and there are a lot of economic activities happening, new business are being created, a lot of things, it will actually boost the job, right? So there will be more jobs, and when there are more jobs, people will spend and a lot of that, right? So let's talk about central bank decisions, right? So the interest rate changes and their QE, which is quantitative easing, it actually it's when they are what they are forecasting, right? So all their expectation is hawkish, it makes the currency to be bullish. But then if their expectation is dovish, the currency will be bearish. So let's talk about political stability right here. So you see, if the politics of a particular nation, everything is stable, there is nothing, no much noise and all that. It's actually safe to invest in such a country, right? So if it actually helps the economy and everything to be stable, right? So and when a country is stable, what happens? It actually attract investors, and when it attracts investors, the more demand, it will the currency itself, it will increase, right? So that's pretty much it. So let's look at a real life example. Let's say US inflation rises to 4.2%. However, the expectation was, let's say the expectation was about 4% or 3.5%. So if it's higher than expected, what will happen? Fed will raise interest rate to fight what? Inflation. And when Fed raise interest rate, it means the interest that you will pay, right, or to collect money, it will rise. And then also the interest you will pay to invest in that economy, to put in the bank, it will also rise, right? So it's actually a two-way thing. But later you get to understand more about this interest rate much more later, right? So it will make investors to buy USD, more of USD for better returns. And then what will happen, the implication is that a currency pair like Euro USD will sell or will go down, right? Why? Because USD is being strengthened, right? So let's take a look at this. Economic data triggers, right? So central bank's reaction, right? However, central bank's reaction actually shifts currency value. I repeat again, economic data, whatever is happening in the economy, that's actually what triggers central banks reaction, how they react, and then how they react, how central banks react is actually what actually shift currency value. So let's talk about technical analysis versus fundamental analysis right here. So we see technical analysis, it looks at chart and patterns. However, fundamental analysis looks at what? News and economy. Technical analysis is actually best for entries and exit. However, fundamental analysis is best for direction and bias, right? So technical analysis is more used by day traders. However, fundamental analysis is more used by banks and hedge funds and the like, big institutions, right? So, but the best practice is use both, right? So if you use both of them, it will give you more precision, right? Using fundamental analysis to determine your bias, and then you are using your technicals for entry and exit. So let's talk about how you can use fundamentals, right? So you have to check economic like Forex factory, right? So that economic calendar. So like Forex factory, you check it weekly to know the news that will be released, and you have to also understand it's not just about checking, understand the data that are being released, right? So you will also have to monitor central bank statement. Also, if you check the news that are being released, sometimes you see their statement and all of that. So you have also get to release and read them. Just try to understand what it means. And I'm going to explain most of this statement much more later, right? So let's talk about let's you helps you to compare economy. So when you see these particular countries in economic data, you also compare with that of another country, that it helps you to compare economy, all right? So different economies, right? So in summary, guys, so what fundamental analysis does, right? So the foundation, right? It helps you to think like an economist, and then you trade like a pro, right? So understanding fundamental analysis, it helps you to think like an economist and trade like a pro. Right? It gives you the real reasons, the why, right? So every big move starts with fundamentals. It helps you to know the why, right? And then you have more confidence, right, with your trade, because you know the why you took that trade, right? So you know why. So it's your trading is data driven, not about guessing. You are using real world insight, right, to know, to determine your trade, right? So the next episode we are going to talk about macro versus micro analysis.